I'm Don Tapscott.
And I'm Alex Tapscott.
And this is What's on Tap. Alex, another crazy week. First of all, there have been a lot of developments and statements that speak to the sort of bifurcation of attitudes towards blockchain, crypto, and digital assets.
Yeah.
You know, on the one hand, you've got, Franklin Templeton CEO Jenny Johnson. That fund manages $1.5 trillion in assets. And she made a statement this week saying that blockchain technology will be hugely disruptive, eventually allowing everyday people to place small investments in otherwise inaccessible assets like major real estate. She says that tokenization and blockchain are going to be highly disruptive to the financial services industry. And we're at the very, very early stages of that. She says, I'm not sure folks completely understand how disruptive this will be. It's something I'm spending a lot of time on, and my team is spending a lot of time on just trying to think about and understand. Mm-hmm. But then on the other hand, you've got these people, now it goes back a couple of years, but Warren Buffett described Bitcoin as rat poison. And there was a survey that was recently reported by JP Morgan that said that 1/3 of mainstream investment firms agree with Buffett's characterization. So that's this sort of schizoid view, really, of all of this stuff. And of course, JP Morgan has been investing lots in this, as has Fidelity. And I guess another sort of news related to this, Fidelity Assets this week conducted a big study, and it found that 71% of institutional investors surveyed plan to invest in digital assets. So
what's going on?
yeah, something going on here, and you don't know what it is. I mean, cognitive dissonance. Either this is the biggest thing ever, or it's rat poison. What do you think?
I think that it's probably not a bifurcation, but a trifurcation. Is that a word? I don't know. So there are the people who are intellectually lazy and are not interested in learning about Bitcoin and blockchain and this whole world of digital assets. And for them, I say, I'm sorry, but you're not going to make it. There's a second group that says, well, blockchain is really interesting, but Bitcoin and crypto, are not so interesting, and they're too volatile, or they're too early stage, or what have you. And then there's a third group that say, well, blockchain is the technology that supports digital assets, crypto assets, and it's in the universe of crypto assets where most of the innovation is actually happening today. And I think that it's that latter group that has really got it right. I think if you look at Bitcoin, you say it's too volatile and, therefore crypto is not worth paying attention to. You're really missing what's going on. It's true that Bitcoin is volatile. So are lots of other assets. And therefore, maybe you shouldn't put 100% of your portfolio in one single asset. But it doesn't mean that the underlying technology or the ecosystem that's being built around that isn't worth paying attention to, or isn't, hugely important to the future. And Fidelity Digital Assets, is a company in the traditional world of financial services. While Fidelity is the company, the digital assets subsidiary, separate entity, is where a lot of that innovation is happening. They just brought on 200 new people to that organization, and they've done a lot of great research into investor attitudes. And it's not surprising. At 9 Point Partners, where I work, we talk to investors all the time who are really keen to understand what this asset class is, how this technology works, and so forth. So that helps to sort of validate our thesis. And in the end, if you want to understand what's going to happen in the future, you follow the money, right? You don't listen to media pundits. You look how leaders of today are actually allocating capital. And what we saw just yesterday was FTX, which is one of the largest crypto asset exchanges in the world, along with Coinbase, Binance, and a couple of others, and probably the fastest growing and the one that's considered the most innovative, just announced that they closed a $900 million financing and an $18 billion valuation. And probably that valuation doesn't actually reflect the amount of money that they make or how quickly that they're growing. But if you look at the types of investors, we've got Sequoia Capital, SoftBank, Third Point, Coinbase Ventures are in there, the Paul Tudor Jones family, Alan Howard, Van Eck, Circle, and a bunch of others. So 2/3 of the names I just mentioned are what would be considered traditional financial services companies or individuals. And if you look at even the Coinbase financings from years ago, the initial rounds were led by the New York Stock Exchange and other traditional kinds of entities. So, there's a lot of media punditry which misses the point, I think, and that everyone should understand that blockchain is something that's affecting many industries. But in the world of financial services, it's the ability to create digital assets, crypto assets, that is leading to most of the innovation. And that's where a lot of the smart money is going today.
Yeah. While you were speaking, I remembered a slide I created a while ago, and I just dug it up here. I'm not going to stick it on the screen, but I'll read a couple of things. But it's essentially addressing the issue of leaders of old paradigms have great difficulty in understanding the new. And, it's the problem of paradigms that these things cause disruption, and they're often received with coolness or worse, mockery, hostility. But just get a few of these. Steve Ballmer, CEO of Microsoft, 2007. Boy, what a leader he was. There's no chance that the iPhone is going to get any significant market share. I'm old enough to remember in 1997 when Ken Olsen, who was the CEO of Digital Equipment Corporation, but a lot of people here never heard of that name. It was the biggest computer company in the world. It was neck and neck with IBM. He says there's no reason for an individual to have a computer in his home.
He said that in 97?
No, sorry, did I say 97? 77.
Oh, okay. He would be very out of touch.
Yeah.
1997.
1977. Time magazine, well, they've had a few beauties over the year. Remote shopping, while entirely feasible, will flop. The New York Times, a rocket will never be able to leave the Earth's atmosphere. Here's a guy from CEO of Century Fox in 1946. Television won't be able to hold any market it captures after the first 6 months. I mean, it goes on and on. CEO of Western Union, the telephone has too many shortcomings to be seriously considered as a means of communication. I'll just do one more. Democracy will be dead by 1950. Actually, there was an author, Short History of the Future. He may have been wrong about the date, but he may be right about the concept, just given what a mess democracy is in the world right now, particularly the United States. We have a total crisis of legitimacy. Anyway, I think that this is happening, but your advice is good. I mean, follow the money, really. What are people actually doing rather than all this stuff?
Yeah, couldn't agree more. Well, it's interesting. Maybe leaders of the old paradigm have learned some lessons from previous paradigm shifts. People who are in leadership roles at a lot of firms today were around in the 90s when the internet bankrupted a number of legacy businesses like Blockbuster, Yellow Pages, right? So maybe they can see that there's the potential for that to occur. It's just been so rare for that to happen in financial services. Most of the times that financial services companies go bankrupt, it's a self-inflicted wound of some kind. They incur too much risk, or there's bad leadership and the company fails as a result of that. But this time the shock to the industry is exogenous. It's coming from beyond their walls, and that's something that I think banks haven't really ever had to contend with. Disruption to financial services is something that the last time that happened was probably in the 17th century with the invention of the joint stock corporation, right? So it's something that I think that they're still paying attention to.
By the way, nice try coining the neologism trifurcation. I just Googled it, and apparently some other people have already said it, though. So,
yeah.
Anyway, it's a good term. I think I'll start using it myself. Okay, let's move along here. So there's been lots of criticism that stablecoins are opaque about what kind of reserves there are backing their coins. And this week in response, Circle published a breakdown of its stablecoin assets, reserve assets. And been a real leader in this space. Any comments on that?
Yeah, I think Circle's been trying to create more legitimacy, not legitimacy, but to really take stablecoins into the mainstream and to get major financial institutions and others really comfortable. And they've been really successful. In fact, yesterday, MasterCard just announced that they're going to be using Circle and USDC in their major stablecoin pilots. So USDC, which is Circle stablecoin, is being integrated into one of the largest payment networks in the world. One of the concerns about stablecoins is what's behind them. Now, there are different kinds of stablecoins. Some of them are decentralized, and the biggest example of that is DAI, DAI, which is created by the Maker DAI protocol. And basically, it's over collateralized with crypto assets. So for every dollar of DAI, there's at least $1, but usually more of Ether and other digital assets. And that decentralized stablecoin has been through various cycles of price volatility and has always more or less held its peg. And so I think a lot of people have confidence in it. But it's still relatively small compared to the whole stablecoin ecosystem. It's around $6.5 billion of total total value. Whereas the entire stablecoin ecosystem is $110 billion. So where's the rest of that coming from? The rest of that is coming from centralized stablecoins like Circle, like USDC. So basically, USDC is a digital asset that tracks the price of $1, US dollar, and it's backed by hard assets. So Circle announced a couple of days ago what's actually backing the Circle USDC stablecoin. And it turns out 61% is backed by cash and cash equivalents. 13% is backed by US dollar certificates of deposits at banks. 12% is treasuries, 9% is commercial paper, and 5% are municipal and corporate bonds. So in other words, about 95%, or I should say about 85% of that is what would be called cash or risk-free assets. So that's a good thing. 9% commercial paper, generally speaking, pretty safe, and 5% municipal and corporate bonds, generally pretty safe. Though it's interesting that it's not 100% cash backing a dollar stablecoin. There's some other assets. So maybe Circle is trying to earn a yield on some of the assets that underpin the stablecoin as a source of additional revenue. And it would be sizable if you think about it. At $15 billion of Circle of USDC in circulation, even if they're making 1.5%, that's $25 million US dollars of basically profit, right, to the firm. So I think that what the step they've taken is one that others in this area are going to take. And I think either they're going to do it voluntarily, like Circle did it, or they're going to be compelled. And we've seen recently Janet Yellen at the Federal Reserve and other regulators raise this issue that stablecoins, as they become bigger and more systemically important to the financial industry, ought to be regulated more, if not more stringently, then they need to provide more transparency about what's backing them. And I think by and large, that's a good thing. And, the CEO of Circle, Jeremy Allaire, would certainly welcome that, as would some others in the space as well. So you have to remember, like $110 billion of dollar value is a very significant market, and is something that is becoming important. So I think this kind of attestation or transparency is a really helpful step in the right direction.
So in the big picture, all the different types of currencies and more broadly digital assets. You've got the community-based currencies. We have securities, of course. There are natural asset tokens. There are central bank digital currencies. Many of, as you and I have discussed. How do you view stablecoins as kind of fitting into this constellation of new forms of assets?
Yeah, well, I think they're one of the most important of that taxonomy that you just described, right? There's sort of forms of digital money like Bitcoin, which are designed to be a medium of exchange and store of value and a unit of account. I think that would be sort of like money in the old school sense, like gold. But then you've got stable coins, which are really more just like dollars. They just happen to be digital facsimiles of dollars. And what's interesting about centralized stablecoins is they sort of bridge the gap between centralized finance and decentralized finance. I mean, you can't say that this is a truly digital native thing if all of the money is sitting in treasuries inside of a bank somewhere, right? I mean, in the end, there's still a very firm foot in the world of traditional financial services. And I think that's okay. And in fact, I think that it's a really interesting sort of example of how existing financial firms should be thinking about this asset class, that they are perfectly situated to be creating products and services like these centralized stablecoins because they have the regulatory moat, they have the licenses, they have the capital, they have the balance sheet, they've got expertise. And I think that with a spark of innovation, they could really, build out businesses like this. There are other kinds of businesses that have one foot in the world of traditional finance and one in the world of decentralized finance. Crypto asset custody is another one. If you believe, like I do, that not only Bitcoin and other crypto assets, but every financial asset will basically be a digital bearer instrument that people trade peer to peer. We don't need all these different intermediaries. Then storing and custodying those assets is going to be very important. And for regulatory security operating reasons, a lot of firms need or would prefer for a third party to hold that on their behalf, right? So boom, there's a multi-trillion-dollar kind of market for banks that didn't exist just a couple of years ago. So these are the kinds of things that I think you can glean lessons if you're coming at it from the world of traditional finance. And a reminder too that blockchain pilots and so forth are good, but there's a big multi-billion-dollar market that's being built adjacent to the traditional financial industry, and you need to learn about that. Otherwise, it's going to eat you at some point in the future. But so we've talked a lot about financial services, and I must admit that I'm sort of obsessed with this right now. It's where I started my career and what I do, kind of every day. But there is more to blockchain than financial services, and you've talked a lot about where blockchain fits in the context of other emerging technologies and how that could affect different areas of the economy and even different elements of life, government, so forth. So you hosted a really interesting webinar on that point, the battlefield of things, which is about the trivergence, as you've described it. Why don't you talk a little bit about that discussion?
Yeah, well, I found myself hosting this webinar today with a couple of rock star former military guys in this area. And, honestly, I'm sort of a bit of the view, you remember the Edwin Starr song, War, what is it good for? Absolutely nothing. But it turns out that, war has always been around. It looks like it's going to be around for the next period. Incidentally, I just read a book that was by a guy named Graham Allison. It's called Destined for War. And he argues that China and the United States are headed for a war that neither wants, but that this always happens. He calls it the reason is the Thucydides trap, which is this pattern of structural stress that results when a rising power challenges a ruling one. Of course, China is now challenging the United States and it looks like is destined to become the dominant power in the world. So hopefully that can be avoided. But given that, there's some big changes. There's a demand pull for new ways of thinking about combat, but also about thinking about security. I mean, during the pandemic, we've had a cyber attack pandemic. We've got infrastructure attacks, shutting down all kinds of stuff, including pipelines. 2 weeks ago, one of the biggest ransomware attacks happened ever, the hack of the software company, Cassia. And that allowed one ransomware group to infect more than 1,500 organizations. And, this is coming. There are big geopolitical implications from this coming from Russia and former Soviet bloc companies. And in fact, a couple of days ago, the White House and other allies accused China of teaming up with criminal gangs to commit widespread cyber attacks, including the one on Microsoft that affected thousands of organizations. So all of this is creating demand pull for a new way of thinking about security and defense. As we're now in the digital age, it's not about so much about fighting for land. It's fighting for and fighting with data, the new asset class of the digital age. And then on the other hand, you got this technology push from these new technologies, the trivergence, as we've called it, the convergence of blockchain, of the Internet of Things, and of AI. And these are creating threats, but they're also creating new opportunities for a more secure world. And it was quite an extraordinary conversation that we had. It was Jim Reganor, who's a longtime collaborator of the BRI. He's a former pilot and he's a colonel, actually, the Air Force, and he's been deeply involved in thinking about blockchain since he left the military in the private sector. And we also had Brigadier General Blaine Holt, who was actually the number 2 representative for the U.S. at NATO, and among other things has been out in the battlefield and so on. These guys held this quite extraordinary kind of conversation where, they called it the battlefield of things. It's sort of, you could call it the IOBT, the Internet Battlefield of Things, where things do a lot of the fighting, but also how these trivergent technologies can protect and enable human soldiers with smart technology. And you think about it, in their armor, in their radios, or their weapons, other objects, to give troops sort of situational understanding. But it's like really crazy stuff that this technology is enabling. Sort of, we end up with this extra sensory perception because you have the physical world sensing all this stuff.
Right.
And fighters can have predictive powers. They can have better risk assessment. They can have sort of real-time collaboration, but maybe even sort of shared intuitions. So for people who didn't attend the webinar, it's one of our biggest ever. I would encourage you to go check it out at blockchainresearchinstitute.org. It's a pretty interesting conversation.
Sounds fascinating. And there's lots of other good content that you can find there, including past episodes of What's on Tap.
All right.
among other things.
Do we have to name them What Was on Tap?
Yes. We should maybe add a segment on What's on Tap called What's Actually on Tap, i.e. what is coming up in the future, which is what that expression means.
What will be on tap?
Took us 10 episodes to figure that one out. Anyway, I think that concludes the discussion for today. See you soon. I know that I will before our next What's on Tap, but we'll see everyone else next week.
So long, everybody.
Take care.